So we're calling next year the Great Transition, the transition from lowflation and sub-trend growth to reflation and above-trend growth. We think that as the world continues to open up post-COVID, and post-COVID comes with an asterisk because of course we're not past COVID, but as that opening up continues with a few road bumps, that the global economy will produce GDP growth of something like 4.3% in real terms. And that's above trend, above history, but it's below what the world produced in 2021. But associated with that will be inflation. So again, we're expecting inflation to be above trend at 3.7%, but below what it was this year. So we think inflation will peak this year. And as a result of that, with above trend growth and the re-emergence of inflation, although lower than this year, that monetary policy will normalise, and that means rising interest rates. So that global view, that economic view that we have informs us on the sectors or the asset allocation that we're favouring for 2022. With the normalisation in monetary policy and interest rates rising, we expect bonds to probably have unfavourable returns. Bonds, government bonds, the yields are low, although they're higher than what they were a year ago. They are low historically. The spread between corporate bonds, high yield, and government bonds is low. And so not particularly attractive returns there. Also, if we look at emerging markets, government debt in emerging markets and corporate debt, similar scenario. Spreads aren't what we would like in the corporate area. Government balance sheets aren't as strong as they used to be because of COVID spending. And as a result, we're not that keen on the bond space. Bonds still have a place in portfolios. They will still protect portfolios in a crisis, but looking purely at return, we're not seeing exciting returns there. The two areas we do like in fixed income are senior loans, and that's because senior loans have a floating rate element to them, and also inflation-linked bonds. Now, with inflation-linked bonds, there's no free lunches. So the whole world is expecting a certain amount of inflation for next year. But where we see the expectations as maybe a little bit too low is in Europe. So we like European inflation-linked bonds. Equities we do like. So we think investors should be overweight equities and have a full allocation to equities, keep cash to a minimum. So in equities, an interesting, a lot of people say, well, after the fantastic returns you mentioned up front, surely there's no value there. Well, it might interest you to know that the PE multiple for MSCI World, the global index, is actually lower than what it was 12 months ago. And that's because earnings have outpaced the price, the price increase. So having said that, also we need real bond yields to stay where they are so that equities on a real basis look as attractive as they are now, and that is predicated on inflation being moderate. So that's the key. Moderate inflation should translate to good equities returns. We're expecting earnings to grow about 7.6% over the coming 12 months, and that translates to an equities return of something similar, sort of mid-single digit to higher single digit. Apart from equities and bonds, we are attracted to alternatives. So certainly we think alternatives will have a better return than bonds, but perhaps not as much as equities. In the hedge fund space, because bond markets, it's a little bit, some clouds on the horizon, and that equity returns, although reasonable, are probably less than what we've had historically, that trend following hedge funds are not the place to be. We're looking for hedge funds that provide a return independent of the market. So what does that mean? Long short equity is an example, diversified macro, and also corporate arbitrage. So they're the type of funds that are playing some sort of corporate event, a takeover, and for example, buying the company getting taken over and selling the company doing the taking over, because the first bid is never the last bid. That's pretty well established. So we have this view for next year, but overlaying that is our super trends. So we think that portfolio should have exposure to those themes that reflect societal change, and we've called them super trends. So super trends, there's 6 of them, just very briefly. The first one, anxious societies, which is to do with probably deglobalisation, ensuring the strength of supply chains and the strength of security, that type of thing. The other super trends, technology, it's quite a clear theme. Millennial values, so that millennial population cohort, what do they like, how are they going to spend their money? Silver economy, which you mentioned, is the greying demographics, so the world is getting older, particularly in developed markets, so what does that mean? And also infrastructure, and then finally decarbonisation and the infrastructure and what's needed for that. But the 2 super trends we're really emphasising for next year are the silver economy. So the silver economy, spending more on health needs. There are some novel treatments and therapeutics coming out, and a clear example is mRNA and the ability to use that for other things than the COVID virus, like cancer, for instance. So the silver economy want to be our senior citizens want to be healthy. They want a good lifestyle, and they will be spending, but they'll also be spending on leisure. So post-COVID, travel, airfares, that type of thing. And then infrastructure is really a story about decarbonisation, sustainable infrastructure. So infrastructure that will enable the electrification of the world economy, that will enable the delivery and production of hydrogen to act as an alternative energy source, and so be able to facilitate decarbonisation. And we're very excited. In 2022, we're teaming up with IFM Investors, the investing arm of the Australian industry super funds that invests in infrastructure, to offer our clients some opportunities in infrastructure. The infrastructure that looks attractive, airports, certainly with COVID, there's some value has opened up there. Also pipelines, so the delivery of, to enable transition, energy transition, so enable the transport of natural gas, LNG, to ensure that transition happens as effectively or as carbon neutral as possible. Also roads, that the world will be bouncing back from COVID and traffic will pick up. And finally, I think the real key is, as mentioned earlier, is infrastructure that enables decarbonisation. And we all know what that is. That's renewable energy, it's wind turbines, it's hydro, it's tide, geothermal, there's all sorts of ways, solar farms. So all of these, not only do you need to generate it, but you need to transport it to where it needs to go. So there's all those different ways to play infrastructure, but that idea of facilitating decarbonisation is front and centre.